All participants, thank you for standing by. Your conference is ready to begin. I would now like to turn the meeting over to Mr. Martin Roy. Mr. Roy, please go ahead.
Thank you. Good day, everyone, and welcome to Deloitte's A Better View Integrated Reporting webcast. My name is Martin Roy, and I am a partner in Deloitte's advisory group in Toronto. I'll be your host for today's webcast. A couple of items before I introduce our speakers and tell you about our agenda. In the lower right-hand corner of the screen are the webcast links, including a link to download and print today's slides and a few other publications we believe might be helpful. You will also find a link for webcast assistance. If you have a pop-up blocker on your computer, you will need to disengage it in order to download the slides or participate in our polling questions. For those of you who know of colleagues who could not attend today's live event, they can simply register at any time for the event, the same way as you did, and they will be able to view the archived webcast within 48 hours after this event. So please feel free to invite your colleagues and take advantage of this feature afterwards. In addition, although you're on listen-only mode, you can ask our presenters content-related questions at any time by entering your question in the box at the bottom of the screen and clicking Submit. We will do our best to respond to your questions during the presentation. We also have interactive polling questions that will appear on your screen throughout the webcast. Again, we invite your participation by simply answering these questions on your screen. A summary of the results will be provided on screen shortly afterwards. Now let me introduce our speakers and discuss the agenda. I'm joined today by two of my partners, Steve Aubin and Stoch, who will be facilitating this webcast. Steve Aubin is a partner in our Calgary practice and provides assurance and advisory services to Canadian and international companies with a focus primarily in the energy and resources industries. Stoch is a partner in our Vancouver practice and leads Deloitte's sustainability and climate change practice in Western Canada and is an expert in risk management and assurance related to environment, safety, and social issues. You can read full bios of our presenters and access the agenda and technical support in the navigation area on your screen. Our agenda for today's webcast will consist of some background on integrated reporting, discussions on why companies are engaging in integrated reporting, and an overview of the integrated reporting framework. We will also provide some insights on lessons learned to date, key opportunities, and how to get started. We will conclude our webcast with a question and answer period, time permitting. We would like to highlight the fact that this webcast does not provide official Deloitte interpretive accounting guidance, and we strongly encourage all participants to consult an advisor before taking any sort of action as a result of this webcast. We would like to begin by asking everyone to participate in this webcast with our first polling question. All responses are anonymous, so go ahead and submit your responses, please. Ensure that you disable your pop-up blocker and to select what you view as the best answer for your circumstances, and then press Submit Answer. So here's the first polling question. How much do you know about integrated reporting, or IR, as we will often refer to it throughout this webcast? A, I don't know anything about IR. B, I've heard about IR, but I don't really know much about it. C, I'm familiar with IR and I want to learn more. Or D, my organization is currently applying IR concepts or is about to apply some elements of IR to our reporting. While we wait for the results of the polling question, I'd like to remind you that today's webcast may be counted towards your continuing professional education. If you stay with us for the whole webcast, you may be able to credit yourself with 1 hour towards your yearly total. Please check with your provincial institutions regarding their continuing professional development requirements. We do not issue certificates for the webcast, but your email registration confirmation can form part of your documentation in support of your attendance. Okay, let's see what the results of our first polling question are. So I guess the majority, I guess 53% said that they've heard about IR, but they don't really know much about it. So clearly it will be a great opportunity for you to learn more about what is IR. And about a third of the participants say that they've never heard about it. So that's a good point also to learn. So I'd like now to turn it over to Steve, who will start by providing us with some background on integrated reporting.
Well, thank you very much, Martin, for the introduction. As Martin mentioned, we'll give an overview of integrated reporting and hopefully give it more insights on the experience that some companies have had so far this year, over the past few years. So let's just start with the reporting landscape. Over the past years, there has been a proliferation of reporting frameworks that have been adopted with varying degrees of success. Both the reporting frameworks and rating system assess a host of financial and non-financial aspects and contain a range of elements such as governance, commitment, and environmental stewardship, human rights, labor practices, and decent work practices. Each of these frameworks have its specific niche, and they're often narrow and specific in scope. The integrated reporting framework differs from the other ones in a number of ways. In particular, it focuses on the ability of an organization to create value in the short, medium, and long term. It is essentially doing so by combining emphasis on conciseness, strategic focus, and future orientation, the connectivity of information into capitals and their interdependencies. Overall, it provides an integrated thinking aiming to improve quality of information available to investors and other stakeholders. The integrated framework was developed by the International Integrated Reporting Council, the IIRC, which brings together a cross-section of representatives from corporate, investment, accounting, securities, regulatory, academic, standard-setting sectors, as well as civil society. It comprises a steering committee, a working group, and 3 task force dealing with the development, the engagement, and the communication of the framework. The journey of the International Integrated Reporting Council started around 2011 with a first discussion paper. Over the 3-year period leading to December 2013, a number of reputable organizations such as the Global Reporting Initiative and the International Accounting Standard Board joined forces with the IIRC to develop the integrated reporting standards. After numerous public consultation, the final framework was issued in December 2013 and is now available on the IIRC website. So, why are the companies engaging in integrated reporting? Companies are really starting to embrace integrated reporting for 3 main reasons. The first driver is actually an internal one. Companies see IR as a way of integrating a broader set of factors that they see fundamental to their long-term success across their business. And they find this helpful to promote integrated thinking and to increase value over time. The second reason is an external one. There is some drivers around competition, as companies are really seeking for ways to demonstrate leadership. They use IR to demonstrate to their investor audience and other stakeholders that they really understand the drivers of long-term success and that those drivers are broader than they might have been typically in the past. These factors include, for example, the access to scarce resources into the future, whether it might be around innovating and the ability to innovate in the context of a changing external environment, and whether it might be relationship with key communities and how they really operate in community allies, giving them an advantage in the future. The third driver is simply a regulatory driver. For example, since 2010, companies that are listed in the Johannesburg Security Exchange are required to adopt integrated reporting. It's difficult to say for sure whether other stock exchange or other countries will follow suit. However, we are seeing an increasing global interest in such non-financial reporting. As an example, the EU is working on issuing a policy proposal which is likely to increase the mandatory nature of non-financial reporting in Europe. So, from an investor perspective, explaining business as usual is not enough. There is a gap between information being reported by companies and the information investor needs to assess the business prospect and value. Notably, investors want to hear in a clear and a concise way three things. First one, how the company creates value over time and really look beyond short-term results to form clearer views of long-term value. Second is they really want to understand a clear identification of risk and opportunities. And finally, they want to understand how the companies are managing these business risk and issues, and most importantly, how they will benefit on the long term from exploiting those opportunities. So let's just take a moment to look at the framework in a little bit more detail. The framework is really based on key principles to allow for flexibility and individual circumstances for each organization to provide sufficient degree of comparability. The framework doesn't prescribe specific performance indicators or the method to evaluate such indicators. And really, they're doing that to leave, once again, more flexibilities to companies. And what's important to know as well is before a company can affirm that they are in accordance with the framework or they're following the framework, they only need a small numbers of they only need to meet a small numbers of requirements. From a Canadian perspective, there's two key messages to remember. The first one is that the framework is not is a voluntary framework, so there's no mandatory requirement at this time in Canada to follow the framework. And two, the integrated report can be provided in a separate report or be integrated with the current statutory requirements. Often, companies start their journey by producing a separate integrated report, and then over time, as they're gaining more experience with the IR framework, they start to fully integrate other statutory requirements such as the MDNA and the annual information form into the one report. A very good example of integration in Canada at this moment would be Potash Corp. The fundamental concepts of value creation can be summarized in this diagram. On the left side, you can find the 6 capitals, which includes financial, manufacture, intellectual, human, and natural. In the center, you can find the business model. The business model includes a series of activities that transform key input and capitals into key output, such as product and services. On the right side, we have the key outcome and how they affect the 6 capitals. positively or negatively. The arrow at the bottom illustrates the underpinning concept of value creation, which is the ability for a company to organize itself to enable financial returns to providers of financial capital and other stakeholders through the use of the 6 capitals. So to illustrate this concept a little bit, there's one of the examples that I like from a software company from SAP. SAP in its integrated report identified 3 capitals that are significant to their business: the financial capital, intellectual, and human. So if we just focus on the human capital, through the implementation process, SAP established that a 1% change in the employee retention has an effect of 62 million euros on its operating results. Understanding and measuring the impact helped them to reshape their business model around employee retention and engagement to minimize turnover cost as well as obtain maximum value from the workforce. This is a very good example of taking human capital and using the business process to increase value over time. This diagram illustrates the six guiding principles and the 7 content elements required to prepare an integrated report. We have already touched a little bit on the guiding principle in the previous slides. However, I would like to just mention that the 4th one here on the left side, materiality and conciseness, is often one of the biggest hurdles that companies run into during the implementation. I will let Henry to speak to that a little bit more in the lessons learned section of this session. The content element, which is on the right side, is fairly straightforward. It doesn't need to be presented in a certain order or in a certain way. Again, this is to allow full flexibility to company to innovate in the way that they present their information. So let's take a couple of examples of integrated reports that are Canadian. The first one is Potash Corp. Potash Corp has been working on their integrated reporting for a few years now. They just published their 2013 report. And if you have a chance to look at it, you'll see they do a very good job at setting out their 5 strategic goals and truly linking them to, in a concise way, to the past results, the current results, and the outlook. And the way they're doing it is very, very visual. The other interesting item as well to note in their report is that they take those 5 goals and they align these with employee and executive compensation. So another example is Unilever. In its 2012 integrated report, Unilever identified value drivers, both financial and non-financial, which are illustrated through case studies and demonstrate the operational activities in markets. The company also includes information on how the business model will create and sustain financial and non-financial value over the long run. These are 2 very good examples if you have a chance to go in and look at those reports as you're starting your journey to the IR framework. There's also another example that I wanted to just to mention. It's Vancity, which is a Canadian credit union. One interesting aspect with their journey is that they have identified confidence and integrity as the underpinning criteria or capitals to increase value over time. And it's very interesting and a very interesting read to see how they're evaluating these 2 items, as well as how they're tracking that over time and reporting to the investors. So Martin, I'll turn it over back to you for perhaps a second polling question.
Correct. Thank you very much, Steve. So before we move on to Henry's portion, I would ask you to please participate in our next polling question. So as you can see on the screen, the question is, which of the following statement best describes your perspective on the link between sustainability performance and financial performance? So A is, there is a strong link between sustainability performance and financial performance. B is, there is a weak link between sustainability performance and financial performance. C is, there is no link between the two. And D is, not applicable, or I do not have an opinion on this issue. So while we wait for the results, we've had a question come in, Steve, that I'd like to ask you. So the question is, can a company adopt or implement the integrated reporting framework on a piecemeal basis?
Definitely, Martin. Often, actually, we see companies just start with a narrow aspect of the IR framework, and they really expand that as they're gaining experience and on the reporting. As you can imagine, and Henry will touch on that, often a company has to reorganize itself in terms of the way that they share information in order to achieve the full integrated report. And really, what you see in practice is company slowly adopting the framework on a progressive basis.
So a little bit is better than none at all, I guess, from an integrated reporting framework. Okay, thank you very much. So let's see what the results are. So wow, I guess over 61% of people think that there is a strong link between sustainability performance and financial performance. So clearly, to try and adopt any portion of this integrated reporting framework would likely highlight this for companies that are able to talk about it. So interesting results. Thank you.
Martin, just as an insight here, in 2012, we asked the same questions to CFOs, and approximately, I believe, 52% of the CFOs also view a strong link between sustainability performance and financial performance. So this is really in line with what we've seen from the CFO suite.
Great. Thank you. Okay, so I would now like to turn it over to Henry, who will begin by speaking to some lessons learned.
Great. Thanks, Martin. Thanks, Steve. I'll actually come back to a point on that polling question that was just answered later on about CFOs and the uptake. That's interesting, but I'll loop back to that. But before we jump into some lessons learned, I wanted to take a minute to talk about the IRC pilot program. Now, thus far, the pilot program businesses are addressing essential interrelated concepts of integrated reporting. That is, the use of capital, the creation of value, and the definition of the organization's business model in the context of an integrated report. The IRC pilot program underpins the development of the International Integrated Reporting Framework. The group of organizations participating in the pilot program have the opportunity to contribute to the development of the framework and to demonstrate global leadership in this emerging field of corporate reporting. According to Paul Druckmann, the CEO of the IRC, he describes the pilot program as their innovation hub, made up of people who want to push the boundaries just a little bit further, to challenge or at least question orthodox thinking, and to acknowledge the importance of integrated reporting to the way organizations should be thinking and behaving. Through the pilot program, these principles, content, and practical application of integrated reporting are being developed, tried and tested by businesses as well as investors. It will run until September 2014, and this comes after the publication of the International Framework for Integrated Reporting in December 2013, thereby allowing participants time to test the framework during their following reporting cycle. This will also enable the IRC to assess integrated reporting outcomes and complete its work. The pilot program comprises of two categories. Firstly, the business network with over 100 businesses across the globe, from multinational corporations to public sector bodies. And secondly, the investor network with over 35 investor organizations. So moving into some lessons learned, and frankly speaking, some pitfalls to avoid. You should view the following slides as issues and points to address proactively as you move forward on your integrated reporting journey. One of the biggest issues we find with companies just starting down the journey of IR is the realization that everyone owns a part of the integrated report. The reality is that for it to be a success, it cannot be designed that way. Roles and responsibilities within the organization should be defined and communicated to everyone, as well as thought put into the resource allocation. It's only natural for people to ask, is this a new department, or does this become someone's additional responsibility? These are all relevant questions and important to respond to. Defining the why for the organization is another lesson we see being learned. Linking the value and purpose of having an integrated report, and even tying the achievement thereof to clear performance goals, is extremely helpful to making it happen. So integrated reporting needs to be grounded in relevant policy, procedures, and frameworks, and the basis of the reporting needs to be aligned with local and international guidelines and frameworks, such as accounting standards and sustainability reporting guidelines. Moving on to looking at some lessons around the reporting boundary, the integrated reporting framework includes the concept of the reporting boundary as a component of the materiality determination process. Considering the organization's reporting boundaries has two aspects. Firstly, the financial reporting boundary, which identifies the subsidiaries, joint ventures, and associated transactions and events included in the company's financial report and applicable according to relevant financial standards. And secondly, and this is where some challenges and snags come in because it's new, is this wider boundary beyond the financial boundary to identify those risks attributable to or associated with entities or stakeholders that are beyond the financial reporting entity, but that can have a significant effect on the ability of the financial reporting entity to create value. So as you can imagine, the materiality concept is really critical to driving the content of the report, and disclosing the materiality process is something that companies are constantly improving in order to demonstrate their logic behind where they're choosing to focus the report content and where they're driving value. Materiality is definitely one of the more difficult concepts to master in the context of IR, mainly because of the different lenses through which one has to view it in order to land on a balanced representation of the issues and focus areas. So looking at systems and data and processes, one of the key realizations that sets in when a company starts down the path of IR is the fact that the level of desired system integration is never optimal. And this is not surprising given that the concept of IR is relatively new. Many organizations choose to go down the path of aligning systems versus full integration over a period of time. And this is often more practical and results in a smoother transition. Currently in North America, many companies are just starting to address this by simply aligning the timing of non-financial data collection with financial data collection and align the actual report release dates. We're seeing that there's a need for non-financial data collection processes to mature to the same level as we see in the financial realm. From an assurance perspective, those who have gone down the path have found it quite insightful. The reality is that there is very often a gap between expected and actual performance. As I mentioned, from a systems perspective, the gap tends to be between the financial and the non-financial data and information. And typically investments need to be made in training on what internal controls mean and should look like from a non-financial perspective. Again, not surprising, just given the different level of scrutiny that has been applied to financial versus non-financial. And a good starting point really is to involve internal audit and have them provide insights and advice related to the non-financial reporting side of the business. So moving on to some key opportunities and areas to think about as you move down this path. What are the opportunities that you should really expect to drive and to derive? We spend time discussing some lessons and challenges, but really, the value has to be in changing the way you plan and manage your business, not just in the reporting. So probably the largest opportunity is to integrate business planning and management. You can't effectively report on integrated concepts and outcomes without migrating in the direction of integrated business management. Conveying the whole story about the organization really does set leaders apart from the rest of the pack. Obtaining consensus and clarity on what's material to the business from a financial and non-financial perspective is very powerful. This is an opportunity that requires a conversation with an increasingly broad group of external stakeholders across the capitals that we heard about earlier on. Again, it's very powerful to gain these insights and act on them in a way that strengthens the business outcomes. Breaking down silos across the organization is always good, and it's amazing how many process efficiencies and general solutioning that teaming can result in. Most of all, it drives a deeper understanding of risk and opportunity across functions in the business. And that's typically what we hear as one of the biggest value adds. And I mentioned earlier about leveraging internal audits. We've seen this being done very successfully. Modern internal audit groups want to add value to the business and help with improvement opportunities. Very often, they have great insights on internal controls, and usually, they have very good knowledge of the business across functions, and are very often the catalyst to developing new or more efficient processes. So if you were to get started and think about moving down this path of integrated reporting, where would you start? What are some of the things you could do? This is obviously not an exhaustive list. And I would say you're probably looking at this and hearing some of the lessons learned and thinking this looks quite large and quite daunting. But the reality is that the starting point is quite simple. And it's as simple as connecting with your peers internally to assess their level of understanding and their level of interest in moving along this path of integrated reporting. Engaging the CFO and assessing his or her interest in driving this process will influence if indeed you do develop an integrated report. And this is where I wanted to loop back to the polling question that we heard a few minutes ago, and we saw the number of people, a high degree or high number of people who said there is a link between sustainability performance and financial performance, and that CFOs, we heard Steve talk about another statistic that CFOs are increasingly seeing that we're finding this important as well. The interesting thing is not many CFOs to date across Canada have really immersed themselves in what integrated reporting means. And so therein lies a significant opportunity to actually align what it means and the implications and what the outcomes could look like. Once you have a working group and you've tackled some of these core issues like defining materiality and defining what value creation means to your business, that's an important next step. Value creation and materiality are critical. So the sooner you get into those discussions and frankly start realizing the differences in interpretation between folks in the sustainability or CSR or non-financial world and the financial world, that will be good as well in terms of timing and getting things moving forward. Ultimately, the concept of describing the broader value statement that your business is contributing can really make a tangible difference to how the market, your employees, and your broader stakeholders can perceive your value and your contribution as a business. So with that, what I'll do is I'll hand back to you, Martin, for another polling question.
Perfect. Thank you so much, Henry. So before we move on to our question and answer period, I'd ask you to please participate in our final polling question, which is on the screen. So here's the question. What do you view as being the most significant challenge in ensuring a successful implementation? So A, obtaining accurate, timely, and complete inputs. B, ensuring all members of management agree and understand the requirements. C, effectively coordinating receipt of required information from many functions across the business. Or D, the good old other. So while we wait for the results, we've received a question for you, Henry. So the question is, if a company currently has a CSR report and an annual report, is it just a case of combining them to get an integrated report?
That's a good question, and I think that is a starting point. This is not a race. I think the key thing to focus on here is starting the conversation and aligning these concepts of what does value mean from an integrated perspective across financial, non-financial spheres. And so a number of organizations have started off that way, just to make people aware and comfortable with the concept. But ultimately, truly moving to integrated reporting requires some, I'm going to say difficult conversations, and I don't mean that in a negative way. I think they are just difficult concepts to align various people's perceptions on what materiality means and what value creation means. So starting off with combining the reports is a good start. Will that get you there? Is that an integrated report? No, it's not, but certainly a good starting point. It certainly highlights or piques people's interest when they start seeing information being reported together or alongside each other or referencing each other in a very strong way.
Great. Thank you. So, okay, let's see the results of our final polling question. So it seems that a majority think that ensuring all members of management agree and understand the requirements would be the biggest challenge in trying to adopt an integrated report framework, followed by, I guess, equally obtaining accurate, timely, and complete inputs, as well as coordinating receipts of the required information. So, no lack of challenges, I can imagine, but seems like a worthwhile cause regardless. So we're now moving into the question and answer period of our webcast. However, before doing so, we always appreciate your feedback, and accordingly, I wanted to draw your attention to a survey icon in the bottom right-hand corner of your screen. Please click on that icon to complete a survey on today's webcast. We take these surveys very seriously, so please continue to send us your suggestions, and feel free to also let us know what we're doing well so we can keep doing it. If we don't get to all of your questions today, particularly if they are regarding specific fact patterns for your organization, I would recommend that you discuss your questions with your Deloitte partner or Deloitte contact so that they can help you resolve any questions or concerns you may have. So let's start with a question for you, Steve. The question is, what were the outcomes of mandatory implementation of the integrated reporting framework in South Africa?
Yes, the South African experience was generally positive and proactive. I think what we found is that most of the business viewed the IR as a refreshing way to look and manage their business, both internally and externally. What's really interesting in going into the second year, which was last year, of mandatory reporting, is that there was a race at the top. Some companies that were very innovative in the way that they were building their report the first year really build on that, and you saw their competitors really feeling that they had to step up their game. Generally very positive, and what we see every year is really an increase in the quality and of the integration. One other thing as well that was interesting is that we've seen some groups, peer groups, that start to be created and by industry in South Africa, and people are discussing what are the indicators, what are the items that companies are focusing on, and trying to bring a bit of a industry consensus in terms of reporting integration. So that's a very interesting story to follow.
Great. Thank you very much. Another one for you, because you're such on a roll. So, if filed with the Canadian regulators along with the MDNA, will the integrated report be subject to CEO/CFO certification and or audit?
Yeah, that's a very good question. I think we get that question very often. The MDNA and the AIF and the financial statements are subject to CEO CFO certification, and both from the Venture Exchange and the Big Board. So all information included in those reports would be subject to this. And as you can imagine, at times it does create a bit of discomfort in terms of when to start to report certain information and certain KPI publicly. And you can see also some companies looking a bit for some assurance from, sometimes it could be from audit firm in terms of getting them comfort in terms of the quality of those numbers. So some companies are not quite ready to fully integrate their internal report or, so to speak, integrate the MD&A and the financial statements with their integrated report. And they have taken the route right now of publishing a standalone report to get their feet wet, so to speak.
Okay. Thanks. Henry, now that you've had a chance to rest a little bit, a question for you. So what are the implications of integrated reporting to the finance function, and how do you envision the interaction?
Yes, I mean, I think there's the implications are probably two sides of the coin. It's both the finance and the financial side who really need to align on certain things. It's probably more the non-financial side of the house who needs to strengthen. When you look at things like data and systems, internal controls, I think there is a gap to be closed just because traditionally the non-financial side of the house hasn't been under the same level of scrutiny. What that means for financial reporting side of the house is bringing them up to speed and aligning them, and that can be a challenge depending on the level of rigor that exists in the organization around non-financial indicators. It really does become specific to the type of business you're in. It becomes specific to where else you report your non-financial data. If it's greenhouse gas emissions reporting, typically that is well managed and compiled and calculated because it's perhaps going to a regulator already. But there may be other indicators that are selected based on them being material. Perhaps those are less quantifiable, perhaps more in the social realm, and that may pose a challenge to folks in the financial reporting side of the house. In terms of getting comfort on how to report some of these indicators and getting comfort around the accuracy and completeness. So I suppose the challenge is going to be felt on both sides of the coin. Again, it comes back to aligning on expectations and building a bit of a roadmap on how to get there, perhaps on the more critical or material indicators first.
Great. Thank you. Another one for you. So what can we do to begin the discussions internally?
Yeah, so just building on what I said right now, I think it starts with as basic a discussion as a coffee chat, saying, hey, I attended this webinar, and what are we thinking about this in our organization? Is it something that makes sense for us? Do we want to look at this as a mechanism to convey the broader value proposition of our business? And so how do you start that conversation is literally connecting people across the key functions of financial reporting and what I would deem as either your CSR, sustainability, corporate responsibility group, to really broker that discussion, to get that discussion going. Most organizations today have a CSR or a sustainability report. And all large public companies have a financial reporting group that work on their annual financial statements and annual financial report. That's the starting point. I think looking at the IRC's website, looking at their position papers, I think will be helpful. But building a common level of education and understanding on the key principles and concepts is really the starting point. And starting that discussion, there's no magic formula. It's literally a case of reaching out internally and connecting with each other on this. Okay,
thank you. Steve, one for you. So to achieve efficiencies, why can't companies modify their MDNA to meet IR needs as opposed to starting from scratch and creating additional reports? isn't value creation already a key objective of the MDNA?
No, that's a very good question, because the person who asked the question is really right, really bang on. I mean, the regulator expects that management really speak about their results and their companies through their eyes, and the IR really accomplishes that. So do we start from the MDNA and go to IR, or do we start from the IR to go to the MDNA? It's always a good question, but I think the first step is really to establish what are the strategic goals of the company, what are the capitals, and what are we doing as a company to create value over time. When these have been identified, and now the company starts to get a good hand in terms of information and reporting, it's really easy to take that and move that into the MDNA and making sure that we meet all the MDNA requirements. So are we starting from the MDNA to go to IR, or IR to the MDNA? I would think that to really have full benefit from the IR implementation, it needs to be starting from a fresh look and really start from the IR and then integrate the MDNA later on.
Yeah, and I'll just add one point to that. I mean, that the idea is, through integrated reporting, is to drive integrated thinking on how you plan and manage the business. And so while current day MDNAs touch on some of that information, and they touch on some risk and opportunity information, I understand why the person who asked the question made that link. There is a link, but Steve, I'm with you. I think one has to take a fresh look at what are we trying to achieve as a business. That's the difficult piece. That's the discussion people are scared of. That's the piece that people want to perhaps not have and just say, tell me what to do. I just want to get this thing done, versus saying, hold on a second, what do we stand for? How do we convey that? Is there a better way that we can do what we do in terms of delivering our service or product? And that's what this is trying to get at. It's definitely not something that you decide to do in 6 months. It's about creating that roadmap, and I do think it's a case of starting afresh, looking at what the objective is.
Okay, thanks for that. Steve, maybe one more for you. Is there currently a process in place in Canada to try and make integrated reporting mandatory?
I don't think there's any real dialogue on this at this point from a regulatory perspective. We don't really have a crystal ball, but if I would try to do an outlook or an expectation on what may happen, I think that the driver will be global. The drivers will be really from some institutional investors and shareholders that will demand from certain companies that are looking for capital to have more information on what are their objectives and how to create value. So I believe it will be driven mainly by the stakeholders as opposed to the regulators themselves. Okay,
so stay tuned for that. Henry, I have a couple more for you. So how has IR impacted the role of the CFO and the CIO? Are there additional challenges for the external audit community in relation to IR?
That's a great question, and I think we're still seeing how it's impacting their roles, but the bit that we have seen, I think, CFOs are really on the hook for all public disclosure, especially for large public companies listed on stock exchanges. So I think these CFOs are realizing that there's a bunch of information that typically hasn't really been under their purview that now will become under their purview, like it or not. And I think I touched on this earlier, that concept of comfort around internal controls, data completeness, and accuracy. I think CFOs are taking another look at, hold on a second, how comfortable are we with the data, with the completeness around the non-financial side of what we're doing? Sometimes it's just the case of the CFO not being aware. Other times there are real gaps in those systems and processes on the non-financial side of the house. The other one is aligning timing, and I think CFOs are struggling with, as they get into this, there's really not an existing time frame where non-financial data is reported at the same time. And what I mean by that is, typically annual reports are 31 December, year-end reports, and then they're released in the first quarter of the following year. What we see with sustainability or CSR reports is they typically are released kind of middle of the year, June, July-ish. And so suddenly CFOs are going, hold on a second, I want this information, but I want it in like February, I want it ready. And so that's a shift, and I think there's a lot of dialogue that's happening and where CFOs are having to do some level setting or expectation setting. From the CIO perspective, the challenge is around systems for sure. And again, I don't think any company can claim to have perfectly aligned and integrated systems, but so with that in mind, the aggregation of disaggregated data is always a challenge. And so how do you make that easy? How do you not overload the organization in terms of systems that they need to be making use of? And so that, from a CIO perspective, it's really that alignment and efficiency around systems to get data pulled on a more real-time basis, or at a minimum getting that quarterly basis, because a lot of the non-financial data is not collected quarterly either. So it comes back to that timing point I made. And from an external audit perspective, challenges, I think, it's interesting to see how that's panning out, because from a financial audit perspective, it's very clear. The standards, the criteria are all very clear. And let's face it, financial auditing has been around for hundreds, if not thousands of years. Non-financial audit has evolved very rapidly over the last 20 years, even the last 15 years. So there is a difference in what is assurance, what is audit, and can everything be assured to the same level? Can you actually audit non-financial data? Does some of it need to be looked at from a review or limited level of assurance? And how do you actually compile consolidated statements? It's easy when you're dealing with dollars and cents, but when you've got tons and liters and kilograms and hectares, how do you develop consolidated, integrated reporting numbers? That's something else that's challenging organizations. Having said that, there are good examples of where companies are working through this. So a bit of a long-winded answer, but hopefully there's some nuggets there.
Great, thank you. One more one for you. Some of the benefits and opportunities of IR appear to be aligned with ERM, which I can only imagine is enterprise risk management, I guess. Is that correct?
Yes, that's right, yeah. Yeah, and so, I think that the person's question is correct, and we've heard and seen people also make the analogy to balanced scorecard reporting as well. The concept of enterprise risk management, if we just dwell on that for a second, but by very nature of what it is, it's trying to take an organizational-wide view on risks and opportunities. And so, yes, I would say there's a real linkage. If you have a strong culture of enterprise risk management in your organization, in theory, the leap to an integrated report shouldn't be as big. What integrated reporting is driving you to do is talk more about value and contribution, both externally and internally. But if you're thinking from an enterprise-wide risk and opportunity perspective already as an organization, there's a lot of information and material and thinking that you can leverage. So there's a real linkage there.
Great, thank you. And maybe one last question for you, Henry, before we wrap up. How do you see the IR framework being modified for broad application to the public sector?
Great question. You know what? I don't have a good answer for you on that front. I think they're going to have to think of something that makes or bridges. Right now, it's focused very much on large public companies or on the private sector. The GRI has very much been the reporting guidance that public sector companies follow. And the GRI, frankly, is something that is followed by any organization that's looking for guidance on non-financial indicators, environment, social, and governance indicators. But in particular, the GRI actually caters quite nicely to the public sector. We do see some crown corporations in Canada who have what I would call combined reports. I don't think anyone truly has an integrated report. But I also don't see a huge leap between the relevance to a public sector organization. I think that if we just look at the very core of it, the concept of what's material and the value that's being added to constituents, I think is something that can be bridged from that kind of private sector or public company view to the public sector. So while I'm not aware of particular guidance that the IRC has given just for the public sector, I don't think the jump is that huge, but I'm pretty sure there will be more around that. And in the absence of feeling like there is much guidance there, certainly the G4, the GRI fourth generation guidelines, will help you tremendously if you're in a public sector organization.
Great. Well, thank you very much for that, Henry. And that will come to the end of our presentation. So thanks again to all of you for joining us, as well as to our speakers, Steve and Henry. We hope you found this webcast helpful and informative. If you want additional information, please visit our website at www.deloitte.ca. This concludes our A Better View Integrated Reporting webcast. Have a great day.